How do you get paid when you buy and later sell a business? Who wouldn't want to know that? In this video, we're going to be talking about the 3 ways independent sponsors get paid, which includes a closing fee, a management fee, and carried interest. And we'll walk through some carried interest examples with this distribution waterfall. And there's a reason I want to revisit this topic. I recently interviewed an independent sponsor who's closed on 4 acquisitions. And he said that early on, if he hadn't charged a closing fee, he probably would have lost it all. I'll explain why at the conclusion of this video, but first we need some context. So let's talk about independent sponsor compensation in the order that it's received. First, you have the closing fee. In my experience, I've seen this sum range from $50,000 to $1 million based on a variety of different factors. And generally, this fee or some portion of it gets reinvested in the transaction. But in practice, and as this 2024 independent sponsor report by Citron Cooperman suggests, it's likely to be within a tighter range between $250,000 and $500,000. The report also points out that this has been increasing, with 25% of respondents claiming that they earned a fee of $500,000 or more. After the closing fee, you have the management fee. Now, at a private equity fund, this would typically be 2% of assets under management. But for an independent sponsor, the fee is hardly ever tied to AUM. And generally what you will see is a structure calling for the greater of a flat fee or some percentage of earnings. As an example, you might see language stating that a management fee will be payable to the independent sponsor in the amount of the larger of $250,000 per year or 5% of annual EBITDA. And I'm just using these figures as examples. They can vary substantially. But generally, you will see a flat fee or some percentage of EBITDA or some combination of the two. After that, you have carried interest, and this is what most people get excited about. Also known as carry or the promote. At most private equity funds, it's equal to 20% of the upside on a successful transaction. So if you invested $10 million and returned $20 million, the sponsor would see a $2 million carry. And we're going to cover a standard structure in this video, but these structures can vary substantially. But regardless of how different these structures can be, you generally have to understand 3 variables to work through the math. First, you have the preferred return. In many transactions, the investors are entitled to preferred return of 8% before the independent sponsor earns the promote or carry. And the greater the preferred return is, the more difficult it is for the independent sponsor to earn their carry. Next, you have the catch-up. The catch-up kicks in once the investors have received their capital back plus the preferred return. And at this stage, all dollars go to the independent sponsor until the distributions equal the promote. And finally, a distribution waterfall can have multiple hurdles. And they can work off of IRR or MOIC. But in this example, and to keep it simple, we're just going to use an 8% preferred return and carry equal to 20%. So let's see how that works with this distribution waterfall. And we have a lot of content on asimplemodel.com that will walk you through this process in great detail. So in this video, we're just going to show outcomes. So let's break this down. In the top left-hand corner, we have our transaction. And we have capital invested and proceeds. And I'm going to assume a $10 million equity check just to keep the numbers simple. Now, the report I cited previously said that nearly 75% of respondents claimed a return of 3 times. So let's set our proceeds equal to $30 million. If you assume you're closing this deal on December 31st of this year, and you're selling it in 2030, that works out to an IRR of 24.6%. And what the waterfall helps you understand is who gets what. We invested $10 million and we got $30 million out of the sale. So what do we do with all these proceeds? Well, let's look at our waterfall. First, you have a return of capital and the preferred return, which goes to the limited partners or the independent sponsors' investors. So in this chart, you'll see that first we have $10 million and then a preferred return of roughly $4.7 million. And if it's shaded blue, it means those proceeds go to your investors. After that, you have the catch-up, and this amount goes to the independent sponsor, which is why it's shaded red. And the purpose of the catch-up is to get the independent sponsor caught up for all proceeds up to this point. So it's equal to 20% of all distributions in steps 2 and 3. A lot of people get thrown off by this math, but I assure you it's very simple, and we have a great explanation for it. It works off of this chart. You can check it out on the website. And I'll be sure to include a link beneath the video player. After that, we have the 80-20 split. And all that means is the remaining proceeds go 80% to the investors and 20% to the independent sponsor. And then at the bottom, we have our grand totals. And in this instance, the independent sponsor would earn $4 million. Pretty cool when it all works out. And this amount naturally increases as the proceeds increase. Had the independent sponsor achieved a return of 5 times the capital invested, they would have earned $8 million in carried interest. But the sponsor only earns carry if they manage to outperform the preferred return. And you can see how that works if we change the proceeds to $15 million. Here you'll see that the independent sponsor only earned $300,000 in carry. And it also helps explain how the investors are protected. They still get all of their capital back and the 8% preferred return. And of course, if you drop below the preferred return, the independent sponsor doesn't earn anything. And that can be truly devastating because this can be a lot of work to show up empty-handed at the end. So as an independent sponsor, it's really important to be thorough about your due diligence, really understand the opportunity, and understand the probability of earning carried interest. Otherwise, it's just a whole lot of work. And the reality is that most business trajectories are not linear. It'd be awesome if every business just performed like this, but sometimes this could happen. And this is precisely what happened to the independent sponsor I interviewed. He experienced an industry downturn shortly after he closed a transaction. And as a quick side note, I really suggest watching this interview because it explores a lot of the challenges independent sponsors face. And Ben really focuses on how to protect yourself in the process. If the company's revenue takes an unexpected downturn, it's possible to trip debt covenants in your credit agreement. And if that happens, your lender can tell you to turn off your management fee. And if you're an independent sponsor with one transaction, that means you have no income, which can make life pretty difficult. If you're considering this as a career choice, you need to prepare to be transparent about your personal financial status. Investors will likely understand this dynamic and want to know that you have the wherewithal to continue if something goes wrong. And if your search process has depleted your savings, then you may want to consider negotiating a closing fee paid in cash. And this won't necessarily be easy. Many investors will ask you to roll or reinvest your closing fee, which means that rather than be paid cash, you receive securities in the company. If you want to pad your savings account, be prepared to negotiate. And do your homework because all three components are highly negotiable. If you have a very attractive deal under letter of intent, you will have a lot more leverage to negotiate the terms you want. So it helps to educate yourself in advance, and there's tons of studies online, and there's also great people to reach out to, like Grant, who I found in this study and happens to be a friend of mine. He works for a fund that funds independent sponsors, and he was a very successful independent sponsor himself, so he's a phenomenal resource. I was a little surprised to see him in the study, so I thought I'd give him a shout out. And we also have plenty of content on ASM covering this entire process in the private equity training curriculum. I created this curriculum with partners at Catton, who've helped me through transactions for years. The materials will walk you through the process from beginning to end, and it'll explain things in detail, like how to work with third parties and what it costs to work with these third parties. We'll even walk you through detailed legal due diligence lists, everything all the way up to the stock purchase agreement, which is the single most important document in a private equity transaction. All right, team, that's all for now. Thanks for watching.